Let's take a look now at one of the most famous parts of all business, the stock market. It's got a lot of stories, a lot of legends to it, but in essence, it's more a matter of exchanging shares of ownership in an organization. Because always keep in mind when you buy stock, you're buying part ownership in an organization. Here's an example of some of the things that we call an IPO. If we recall, there's two different markets. You have a primary market, and the primary market was where the company first offers its shares to sell. Usually, we sell them to investment bankers and a whole range of people who have lots of money, especially some of the institutional investors with billions to spend. And then once they buy up all the initial stock from the corporation, they turn around and they sell it into the public market, which we call the secondary market. So here are some of the examples of an IPOs that I chose just for an example. Here, you can sit down and just go on your computer right now. You can find the IPOs coming out for this week. You'll see the estimate as to the name of the company, what exchange we posted on, what the expected range of the stock to be. They're hopeful because every single dollar means a lot more different shares. You can see Bosch and Lomb here when it came out their IPO, they're selling 35,000 shares in the whole process. Like, whoa, that's huge. Well, if it just goes up $1, that's $35,000 more into their coffers as a corporation. And hopefully, the people that are buying that, they're sitting there hoping that it's going to go up to $30 next week and they'll make a huge killing. That is kind of how it works. So here's some of the IPOs in the market. And you also have another critter out there that we call a SPAC. A SPAC is a special purpose acquisition company, and it really is one of these things. It's been around for multiple decades. It really got to be a super hot commodity right about 2014, 2015, and then it was booming all the way through about the year 2022. A SPAC is a special purpose acquisition company. So you have somebody decide, hey, I want to go out and I want to have a company that's going to buy a technology. Well, what kind of technology? I don't know, something over in the technology field. So they get a bunch of investors together. A lot of times they get somebody who really knows about finances from Hollywood. Yeah, right. They're an actor. Okay, so they go out and they have the special purpose company, and they buy they sell stock into a company, and they save a lot of time. An IPO is really nice, except you need to pay attention to the IPO. What does it take? And the SPAC eliminates the need for an IPO. Really your IPO, if you go back to this, the IPO takes a lot of time of the company. They need to go sell, sell, sell. The chief executive officer of the company hardly spends time in the company running it while he's running around or she's running around selling up the aspect. When you come out here, make sure you sit there, buy a lot of stock in this over here. So they're trying to sit down there like the Bosch and Lomb CEO ran around trying to get people to buy their stock. It takes a huge amount of time away from the corporation. Now, a SPAC, let's say you want to have a technology company, a SPAC is already sold stock into this organization, and the SPAC goes out and they sell the stock, and they're already a corporation. What happens, what they do is there's no commercial operations. They raise capital through their own IPO instead of a company, okay, for the purpose of acquiring the existing company. Another name for SPAC, we normally, for slang, we call them a blank check company. So a blank check company comes in, you don't know exactly what company they're going to buy. You're investing into it, buying their IPO for the SPAC, and the SPAC merges, and all of a sudden now they buy a company and they merge the two companies together, and they don't displace anybody in the new company. What happens is you just have the SPAC. Maybe they've raised $150 million. They buy out all the stock of another company and they merge, and the name of the SPAC disappears and it becomes one and the same company with their own existing board of directors, which really came from the SPAC itself. Here's an example here, Pershing Square Holdings. So you have that. What's their goal is to analyze. They're going to sit down, they're going to buy stock. They sold it for Class A over here. So their action is if you want to buy it, you're in, but we don't know exactly what they're going to be. Capital groups, you'll see this Churchill Capital, they have their corporation, it's a SPAC, and eventually they're going to merge with another company and take it over. This is not going to be on your test. This is not even in the textbook. It's just something you need to be aware about since we talk about it occasionally in the stock market. A lot of times it's a startup or if a private company, they're looking to list on Wall Street. If they use a SPAC, if they sell it to the SPAC, they have a meeting with the SPAC, and all of a sudden, boom, they make a decision. Instead of running around for 8, 9, or 10 months trying to sell an IPO, they sell it to the SPAC, and the SPAC has already done the IPO and they merge it, and all of a sudden, boom, you have a giant merger between two companies. The SPAC title disappears, and all the different assets they merge together. The capital from the SPAC, the company over here, they merge it, and all of a sudden, in a matter of a wink of an eye, compared to an IPO, they have a lot of money. When you look on the stock exchanges, you have to really, as soon as you start selling stock to the public, you come underneath the jurisdiction of a federal group called the Securities Exchange Commission. And if it's a different company, they'll have their own version of it, but it's a federal agency responsible for its exchanges. One of the things required for anybody that sells stocks or bonds is that you have a prospectus, a condensed version of economic and financial information. It's all right there. It's all written in at least 4-pitch font. I'm not really kidding about that. It actually is teeny tiny font. If you decide to get a printed version of it, they cram it all together, and they're out over there. And the prospectus tells about the company and what they want to have. And if you're buying stock, you have to get a copy of the prospectus by law to know what you're buying into. So the Securities Exchange Commission is a federal agency. Make sure you know what that is. Know what a prospectus is because it has all the information you'll need about the company. And there's a lot of micro detail in there. And you'll see their plans out there laid out, sometimes really well, sometimes really vaguely. You have another thing if you're going to have this aspect of selling stock. If you're selling stock, you have to worry about a concept called inside trading. Inside trading, what happens there is involves buying or selling stock based on secret information that the public doesn't have. If you have it and you say, buy stock now, buy stock now. We got a great tool coming out over here and it's going to revolutionize everything in the washing machine industry. You watch, we're going to really clean up on this one. If you whisper that to your best friend goes out and they buy 100,000 shares of stock, and all of a sudden it comes out and the stock's price skyrockets. That person has just participated with you in insider trading. Now, unfortunately, we have a lot of people in our Congress and Senate that actually have this type of thing. They anticipate over here. They don't know which company, but all of a sudden they buy, and you'll see that out there, and that should be a concern to us as Americans. But regardless, insider trading, that's out there. Foreign stock exchanges, you can buy securities from companies almost anywhere in the world. A lot of foreign investors can invest in US securities and also have a chunk of our corporations here in the United States. That does get people worried a little bit. Whenever you buy stock, a stock is a share of ownership in the company, and you're entitled to have a paper stock certificate. And you'll see somebody, just, I have a million shares of stock. Most of it is primarily from old gold mines out here in the western part of the United States that went bankrupt decades ago. They're just kind of fun collector's items. For the most part, you'll probably never see a piece of paper as a stock certificate unless you specifically request it. Almost everything is really digital now. Also, if you own a share of stock, a corporation has to do something with this profit. It can retain the profit. When it does, we call it retained earnings. It will retain its earnings and plow it back into the company. If they want to distribute the profit, they pass it out to all the shareholders appropriately. So if you get 100 shares of stock, you get 100 different dividends, or the equivalent of 100 dividends for that share of stock. If you have one share of stock, you get the equivalent of one share of stock. If you got 1,000,000 shares of stock, you get 1,000,000 dividends. So you break it up that way by the number of shares of stock you have, and you'll actually get a check. Now, on the check, if you recall, when we talked about corporations, one of the issues on dividend checks is the company is already taxed. At the time of this recording, the federal tax is 21%. And the company's already paid that. If you're in the 28% tax bracket, you'll also get a dividend, and the dividend is going to come and you'll pay taxes on that. So by the time you're all done, that profit you're getting, you're going to pay 28%. The corporation already paid 21%. You're already paying 49% of all the profits that the federal government in the United States get. Believe it or not, in other countries, it can actually be higher than that. So dividends is really the distribution of the profit of the company to all the shareholders, and also, or it can keep that, we call it retained earnings. The advantage issuing stock is the shareholders are owners of the firm, and you never have to repay the investment. We're going to talk about bonds next. If you sell bonds, you have to repay the bonds because it's a loan. On the stock, you never have to repay it. There's no legal obligation, by the way, to pay dividends. Sometimes if you do, you're better off because people get upset because of it. Well, I have all the stock and there's no benefit for me. Well, sometimes the benefit of the stock itself is that the stock is growing. If you pay attention to some of the stocks out there, one example we mentioned already was Berkshire Hathaway. You're talking about almost $500,000 a share for one stock. You look at Amazon. Amazon has had a huge growth rate. So part of it, we call that a growth stock because it does retain its earnings instead of distributing the dividends. So you see, the benefit is that a lot of times, if you're buying a stock, the price keeps on going up and up and up because the company keeps on expanding by keeping its retained earnings. Issuing stock can improve the firm's balance sheet since the stock creates no debt. That's an advantage. Now, the disadvantage is that the shareholders have the right to vote. Well, if you're the CEO of the company, you got to keep those people on your board of directors happy. Now, the board of directors are elected at the annual meeting, which is required by the SEC, the Securities Exchange Commission, and there they make a decision who's on the board of directors. Well, let me give you a clue. If you have 50 million shares of stock and somebody has 10 million shares of your stock, they're going to probably vote themselves onto the board of directors because, gee, they have a pretty vested interest in your corporation. So you better make certain that person and the board they're happy with you as a CEO. If not, you may be sitting out at the curb and have somebody else sitting in your chair. That's always part of it. So that's why you have a board of directors. So dividends are paid from after-tax profits, and they're not tax deductibles. You need to keep the stockholders happy as it can affect the manager's decisions and also the board's decision as to whether or not that manager is still there. The most common stock is called common stock. It's a basic form of ownership. It confers voting rights and the right to share in the firm's profits through dividends. Holders of common stock have the right to elect members to the board, and they have a share in the firm's profit through dividends if it's approved by the board to distribute dividends, and also purchase new shares of common stock before anybody else. Those are three rights. So initial public offerings, we talk about IPOs. Here's an example. Pinterest came out with their IPO. They raised $1.4 billion from the sale. You can see why it's to the advantage of the company actually sell stock because they have all that initially. But keep in mind, as soon as they sell it, they're selling shares of ownership, and those people have the right to vote for whoever sits on their board. So you also have a thing called preferred stock. Preferred stock is different from common stock. Usually, preferred stock does not have voting rights, and preferred stock, it acts a lot like stock and it acts a lot like bonds. So you call it stock, but still it's a matter of it's callable, so you can call it back. You can convert it. In other words, you can have preferred stock, and you might have a clause in there saying, if you have this share of preferred stock, it is convertible to 10 shares of common stock after holding for 3 years. So 3 years later, you're looking at it, you paid $100 for the preferred stock, and all of a sudden you look over here, you can get 3 shares of common stock after 3 years. So all of a sudden it changes. And it's a matter of you can convert it over to common stock. And what if the common stock was selling for $100 a share? So 1 share of preferred stock, 3 shares of common, all of a sudden you have a 300% profit. It really can be kind of cool that way. Usually preferred stock is often sent for companies that are in trouble. You'll see preferred stock, so watch it closely. It's a very interesting investment, but make certain you understand why they're selling it because of the fact that sometimes companies, they're in trouble and they decide to sell preferred stock in lieu of bonds because bonds are repayable. Also, preferred stock is cumulative. In other words, if the company has a dividend and they decide not to pay it that year, if they decide several years later to pay dividends and they want to sit down and say, we're going to pay a dividend of 7%, all this preferred stock does is they get cumulative dividends over the period of time that they weren't paid. So it really is a benefit big picture wise, it looks a lot like bonds, but we call it stock. So it's kind of a very strange thing because it really isn't this netherworld of neither foul nor bird in the process of stock and bonds. So the terms to remember: what a SPAC is, special purpose acquisition company; common stock gives you a share of ownership in the company; preferred stock, it does not give you a share of ownership in the company and you cannot vote with it, but you have preferred dividends before anybody else does. An IPO, initial public offering, know about the prospectus, and the prospectus is that document you get when you buy stock or bonds. Dividends are that whole thing, is the distribution of profit to all the shareholders, and the SEC is the Securities and Exchange Commission, which is the United States federal agency. The stock market, complex, interesting, fascinating, especially if you're stock and you're making money. It's not so fascinating if you have stock and you're not making money. Take care.